Have you ever felt that sinking sensation when your credit card statement arrives, knowing you've been responsible with your spending, yet somehow the numbers never seem to work in your favor? That gnawing feeling that the banks are always one step ahead, profiting from moves you didn't even know you were making? Meet Harry. He's a 28-year-old marketing professional who considers himself financially responsible. Harry pays his bills on time, reads financial articles, and tracks his spending carefully. But what Harry doesn't realize is that despite his diligent efforts, there are important credit card industry practices that could significantly impact his financial well-being. Practices that most consumers simply aren't aware of because they're buried in complex terms and conditions. These aren't illegal schemes or predatory scams. They're perfectly legal business strategies that credit card companies use to maximize profitability. Today, we're exploring 7 important industry practices that could help you make more informed decisions about your credit card usage. Understanding these can potentially save you hundreds or even thousands of dollars over time. This video is for educational purposes only and does not constitute financial advice. Always consult with qualified financial professionals before making financial decisions. The strategies discussed may not be suitable for everyone's financial situation. Fact number 1. The minimum payment design. How small payments create long-term costs. If you're like Harry, you might occasionally rely on minimum payments during tight financial months, thinking it's a reasonable way to manage cash flow. The minimum payment keeps your account in good standing, so it seems like a safe option. However, there's an important cost calculation that many consumers don't fully understand. Minimum payments are calculated to extend repayment periods significantly, which maximizes interest charges over time. On a $3,000 balance with a 22% APR, paying only the minimum payment typically results in a repayment period exceeding 19 years. During this time, you'll pay approximately $6,500 total, more than double your original purchase amount. This isn't accidental. According to Federal Reserve data, credit card balances have reached $1.18 trillion nationally, with average interest rates around 20%. A June 2024 Bankrate survey found that over 50% of cardholders carry balances month to month, generating substantial interest revenue for card issuers. The psychology behind minimum payments is sophisticated. The term minimum suggests adequacy, that you're meeting your obligation responsibly. However, from a long-term financial perspective, paying only the minimum can significantly increase the total cost of purchases. Actionable strategy. Whenever possible, pay your full statement balance to avoid interest charges entirely. If that's not feasible, pay as much above the minimum as your budget allows to reduce the total interest paid over time. Fact number 2. Grace period conditions. When interest-free periods disappear. Harry always believed that paying his statement balance by the due date guaranteed he'd never pay interest charges. This understanding is mostly correct, but there are important nuances that can cost hundreds of dollars if overlooked. Grace periods are more fragile than many consumers realize. If you carry even a small balance from your previous statement cycle, you typically lose your grace period on all new purchases. That means new purchases begin accruing interest charges immediately, rather than having the standard 21+ day grace period. Cash advances represent another area where grace periods don't apply. These transactions begin accruing interest immediately at typically higher APRs, often 25 to 29%, plus upfront cash advance fees of 3 to 5% of the transaction amount. Many consumers don't realize that certain transactions are classified as cash advances, including some peer-to-peer transfers, cryptocurrency purchases, and certain bill payments. Balance transfer offers often feature attractive 0% introductory APRs, but they typically include balance transfer fees of 3 to 5% of the transferred amount. Additionally, new purchases on balance transfer cards may not qualify for promotional rates and could begin accruing interest immediately. Actionable strategy. To maintain your grace period, pay your full statement balance every month. Be aware of which transactions count as cash advances and read the terms carefully for any promotional offers. Fact number 3. Credit score reporting timing. When payment timing affects your score. If you're like Harry, you probably monitor your credit score regularly and understand that credit utilization is important. However, many consumers don't understand the timing aspect of how utilization is reported to credit bureaus. Credit utilization accounts for 30% of your FICO credit score. Most credit card companies report your balance to credit bureaus on your statement closing date not your payment due date. This means even if you pay your statement balance in full every month, a high balance on your closing date could negatively impact your credit score. For example, if you have a $5,000 credit limit and a $4,900 balance on your statement closing date, credit bureaus see 98% credit utilization, even if you pay that balance off completely 3 days later. This single snapshot could potentially lower your credit score by 50+ points. Credit limit increases are often offered strategically. Card issuers use sophisticated algorithms to identify consumers who are statistically likely to increase spending when given higher limits. While higher limits can improve your utilization ratio if spending remains constant, they can also lead to increased spending for some consumers. During economic uncertainty, card issuers may reduce credit limits, sometimes below current balances. This can instantly create over-leveraging situations that negatively impact credit scores. Actionable strategy. Consider making payments before your statement closing date to ensure lower balances are reported to credit bureaus. Monitor your credit utilization across all cards, aiming to keep it below 30% overall and ideally below 10% for optimal scoring. Fact number 4. Fee structures. Understanding the full cost landscape. Harry considered himself fee-aware until he discovered the extensive range of charges that can apply to credit card accounts. Beyond obvious costs like annual fees and late payment fees, there are numerous other potential charges. Foreign transaction fees of 2 to 3% apply to purchases made in foreign currencies or from foreign-based merchants. This can include online purchases from international retailers, even if you're shopping from home. Late payment fees aren't just about the immediate charge of $30 to $41. A single late payment can potentially void promotional APRs and trigger penalty rates of up to 29.99% on your entire balance, creating much larger long-term costs. While over-the-limit fees were largely restricted by the 2009 Credit Card Act, they still apply if you opt into over-limit coverage. Card issuers must obtain explicit consent before charging these fees. Additional fees can include expedited payment fees, statement copy fees, card replacement fees, and premium card design fees. While individually small, these charges can accumulate over time. Actionable strategy: review your card's fee schedule in the Schumer box before applying. Choose cards that align with your usage patterns. No foreign transaction fees if you travel, no annual fees if the benefits don't outweigh the cost. Set up automatic payments and alerts to avoid late payment fees. Fact number 5. Rewards program economics. Understanding the true value proposition. Harry enjoyed his rewards programs and felt smart earning cash back on purchases. However, rewards programs have economic realities that are important to understand for optimal usage. Rewards programs are primarily funded through merchant fees and, for some cards, higher APRs. If you carry a balance, interest charges at 20% plus APR will quickly negate any rewards earned at 1 to 2% rates. Research indicates that rewards cards can psychologically encourage increased spending. Studies suggest people may spend 12 to 18% more when using rewards cards compared to cash, potentially offsetting the value of earned rewards. Rewards values can change over time. Card issuers may adjust redemption rates, add fees, or modify program terms, potentially reducing the value of accumulated rewards. Some rewards, particularly airline miles or hotel points transferred to partner programs, may have expiration policies or inactivity clauses that could result in forfeiture if accounts aren't used regularly. Actionable strategy: use rewards cards only for planned purchases you would make anyway. Always pay your statement balance in full to avoid interest charges. Understand redemption options and use rewards before any potential expiration dates. Fact number 6. Merchant fee impact. How processing costs affect everyone. Here's an industry practice that affects all consumers, even those who don't use credit cards: merchant fees. When Harry uses his credit card, the merchant typically pays 1.5 to 3.5% in processing fees to various entities in the payment ecosystem. These merchant fees are generally incorporated into the pricing of goods and services, meaning all consumers, including those who pay with cash, help subsidize the cost of credit card processing. This creates an indirect subsidy system where cash users help fund credit card rewards programs. For card issuers, merchant fees represent a significant revenue stream that doesn't depend on cardholder behavior. Even customers who never pay interest or fees generate revenue through these transaction-based charges. This fee structure helps explain why credit card companies actively market their products and offer sign-up bonuses. They profit from transaction volume regardless of whether individual customers carry balances. Actionable strategy. Understand that credit card convenience comes with embedded costs in the broader economy. Use this knowledge to make informed payment choices and maximize any rewards you receive from participating in this system. Fact number 7. Data analytics and personalization. How spending information creates value. If you're like Harry, you might not think much about the data generated by your credit card usage. However, transaction data represents a valuable asset for card issuers beyond the direct fees and interest they collect. Credit card companies analyze spending patterns to understand consumer behavior, predict life changes, and identify financial trends. This information helps them optimize product offerings, adjust credit limits, and target marketing efforts. Aggregated and anonymized spending data can be valuable to retailers, market researchers, and other businesses seeking to understand consumer trends. While personal information is protected by privacy laws, spending pattern data has commercial value. Card issuers use transaction data to assess risk, predict payment behavior, and determine appropriate credit limits and terms for individual accounts. This analysis can influence the offers and terms you receive. Some card issuers offer spending analytics tools to cardholders, helping them understand their own financial patterns. These tools can be valuable for budgeting and financial planning. Actionable strategy. Review your card issuer's privacy policy to understand how your data is used. Take advantage of any spending analytics tools provided to better understand your own financial patterns. Be aware that your spending behavior influences the offers and terms you receive. Key takeaways for informed credit card usage. Understanding these industry practices doesn't mean credit cards are inherently problematic. When used strategically, credit cards offer valuable benefits including convenience, security, fraud protection, and rewards. The key is using them with full awareness of how they work. Credit cards can be powerful financial tools when you understand their complete cost structure and use them strategically. Pay your statement balance in full when possible. Understand fee structures, optimize your credit utilization timing, choose cards that match your spending patterns, and use rewards without increasing your spending. The most important principle is to remain an informed consumer. Read terms and conditions, understand fee structures, and make decisions based on your specific financial situation and goals. Remember, this information is educational and not personalized financial advice. Your optimal credit card strategy depends on your individual financial situation, spending patterns, and goals. Consider consulting with a qualified financial advisor for personalized guidance.